This video is going to be quite different to the regular video on this channel. Usually I talk about charts, I talk about data points, I talk about the current market, what kind of assets are currently cheap or expensive, how can we rebalance portfolios, etc. In this video I want to talk about something more fundamental. I want to talk about the psychology of money, as in how does our risk appetite change over time, how does our utility of money change over time as we become more wealthy. Because when I was a poor student, right? When I didn't have regular income, then I couldn't really fathom how somebody would be okay spending thousands of extra dollars for flying business class, or even more dollars flying first class, or even be okay, so spend hundreds of thousands of dollars for private travel. If you have that much money, if you're that good at making money, why would you be willing to take such a bad deal and spend so much extra dollars just to have a little bit more leg room in a plane, just to have potentially a bit more privacy when flying? It didn't really make much sense to me. But of course, as wealth increases over time, every single dollar that we get means less and less to us, right? If you've got just $100 and we then double this to $200, suddenly we're very happy. We double this again to $400. It kind of matters to us because now we can pay the electricity bill, we can pay the mobile phone, etc. But when we are in the hundreds of thousands of dollars or millions of dollars, then those small little changes don't really matter that much to us anymore. They pretty much don't matter at all if we are honest to ourselves. Now, I think that's a totally natural phenomenon. We shouldn't be taking that much care of a single dollar if we've got that much wealth. Just think about it. Let's say you get two games offered. The one game is you've got a 10% likelihood of becoming a billionaire and a 90% likelihood of not having any money at all. That's game number one. Game number two is that you've got a 99% likelihood of only getting, say, 10 million, but only a 1% likelihood of having zero. When we actually look at the expected value of both of those games, everybody should be going for the $1 billion, right? Because there we've got roughly 100 million of expected value. 10% times a billion. But most people, realistically, if there's no kind of trading involved, if you can't do any fancy games, they'd still go with a 99% likelihood of getting 10 million, because 10 million means financial freedom for most people. For most people, it's very hard to achieve that milestone. So by that example, we can already see that for most people, the first 10 million that we earn are worth much more to us than the subsequent 990 million. Being a billionaire is not as important as having the 10 million. Now, what does this mean for risk tolerance and for investments? Let's say there would be a completely neutral casino. So a casino that goes completely 50-50. There is no edge, there's no long-term losing against the casino. Either we double our money, let's say with roulette, or we lose our money, right? It's either plus 100% or minus 100% with an exactly 50-50 chance. If we get offered such a game in the casino, we should actually not play that game. Because when we double our wealth, especially for larger amounts, when we double our wealth, the utility will not double. It will decline. So let's say we've got $100,000. We would bet $50,000 on this game. We've got the chance of having either $150 or just $50. Having $150 doesn't make us 50% more happy compared to having $100,000. But only having 50K versus 100K, this is quite a bit of a problem. This decreases our happiness by more than 50%, or let's say our utility of money. So fundamentally, what this means for us is that we should rather be risk averse, that we need to have a minimum return expectation in order to enter an investment. We should only invest if our expected return is high enough, especially if there's risk involved. But that then begs the question, what kind of investments are actually worth doing? Because let's say with the S&P 500, we get a long-term expected return of somewhere between 7 to 9% per annum, but at the same time, the monetary base is expanding by that same rate. So really, very long term, we don't have that much expected return with stocks. We do have dividends, but we also have taxes. We've also got management fees with funds. So really, long term, we don't gain much with stocks. The same is true for gold. When we actually look at the very long-term S&P 500 to gold ratio, we see how this fluctuates up and down and up and down. Gold very long-term doesn't necessarily underperform stocks by that much. We're simply just preserving our purchasing power. But we're introducing quite a bit of risk. So really, the only reason to get into an investment is to have either higher returns than just the 7, 8, 9%, so buy something like Bitcoin, or potentially buy something that cheap, that depressed, when most people don't want to buy it, that we will get longer expected returns out of that thing. So let's say we buy property during the property crash, or we buy stocks during the global financial crisis, or we buy technology after the dot-com bubble crash. Whatever it is, right? It seems to make sense to try to preserve our capital most of the time, be diversified to a degree that the volatility doesn't kill us, that monetary debasement doesn't destroy our purchasing power, but really we should only be invested heavily into a single asset when we can expect very, very high returns. We should not invite a lot of volatility into our wealth if we don't have that return expectation, because again, a 50% loss is much more painful to us than a 50% gain. We need to have sufficient upside. There's also this interesting fallacy that people that haven't been able to save and invest enough yet, that they think once I reach a certain threshold, then I will be content. Then I don't want to grow my wealth that much anymore. Once I hit the $1 million mark, I'm okay. But rarely is this true. And that's a problem with many people that, for example, gamble with meme coins, right? They put maybe $1,000 in a single meme coin. They hope that it will do 1000x. More often than not, of course, this will not happen. But whenever it does happen, every now and then we see people succeeding to that degree. Most of the time, the wealth is lost subsequently, because when you made money once with that approach, you will try to continue to make money with that approach. Everybody might remember the Dogecoin millionaire that went on various podcasts and actually never sold and had the ability to sell for very, very high. And many people advised him to at least diversify to a degree. But that's a problem with greed, right? Once an approach is found that works somewhat well, you're trying it again and again and again. And if the long-term expected value of that bet is not positive, then it's just a matter of time until the wealth evaporates again. I know when I say things like this, it's not necessarily sexy, but instead of trying to find the next 10 or 100x meme coin, it's much better to work very, very hard to save as much money as possible and then try to find ways to compound this at a rate that's above average. Try to compound the capital maybe by 20, 30, 40% through various means, right? Let's say property, right? You put down 10%, you lever this up by 10x by having a huge mortgage, and then you appreciate because your debt devalues. That tends to be quite high in ROI. Or let's say through a Bitcoin purchase, when Bitcoin has crashed quite a bit, when nobody wants to hear about Bitcoin, but when you believe that the asset will stay around long term, you can buy the bottom, you can get those nice long-term returns. Those kind of approaches tend to work much better over the long term than trying to hit the home run once. Life seems to be working in quite mysterious ways. Whoever has been able to hit the home run tends to lose the money if the skill doesn't follow, if people don't learn about what to do with all of those funds. There are countless stories of winners of the lottery that 2, 3, 4 years afterwards have lost it all. And again, that's because people didn't really up their skills to the same degree. It seems like wealth and wealth management skills go hand in hand. And if there's a disparity, the wealth tends to go towards the skill level at some point in time. If you learn a lot about wealth management, if you learn a lot about how to create more return on investment, then over time, when your skills are higher than your current wealth, your wealth tends to approximate to those higher levels again. But if you make it lucky and you overshoot your skills, then you will come down to your skill level again. There seems to be some kind of a long-term equilibrium here. Now, I do understand the urgency of the young folks, right? If you're currently 20 or 25, of course, you want to make it big as quickly as possible because you can also enjoy the money more the younger you are. What does it really help when you're 60 or 70 years old and buy the Lamborghini at that age? Isn't it much cooler to be young and rich rather than old than rich, right? Most people would be okay giving away all of their money just to be young again. But it's the same with most things in life. A healthy balance seems to be the right thing. So we don't have to necessarily make our wealth in 1 or 2 years, but we don't have to wait until retirement to become rich. If we've got a time horizon of 5 years, maximum 10 years, that's still pretty realistic to make $1 million. Not necessarily by just selling out time and investing this in the S&P 500, but definitely if you currently have a main job and you've got a side hustle on the side that maybe pays 50% of your main job, and you save all of that money that you make with the side hustle, and then you figure out how to compound that wealth very quickly. Let's say you then buy Bitcoin when it's very, very low, or let's say you work on relative valuation trades, or let's say you do something like property investments when property is rather cheap or when financing costs are low. When you do something that tends to outperform just regular buying and holding of the stock market, you should be okay. You should be able to reach sufficient levels of wealth by the age 30, 35, potentially 40. The question again is about the utility of money. Of course, the more money we have, the less $1 is worth to us, but also the older we get, the less $1 is worth to us. We can't really enjoy our money that much anymore once we are 70, 80, 90 years old. But it is very important to have a proper nest egg once we want, for example, a family, right? Or once we want to take care of other people. It's important to be willing to learn more and more, both on the income side, as in what kind of skill you currently have, that you upskill further and further, you can sell more per hour, but also in terms of investments that you can get more and more of a return over time. So really, it's a skill acquisition game. It's not necessarily how many hours one sells. It's not necessarily about working 100 hours every week, but it is important to invest in oneself very frequently. So this can be reading books, this can be watching podcasts of people that are already there where you want to be. This can also be learning more about the particular craft that you currently earn in. When you're young, not the cash flow every single month is important, and not the returns on the investments are important. What really matters is increasing skill at a very high rate. As in, you don't want to sell too much time. You want to maybe only work 30, 40, 50 hours, but you definitely want to take at least 10, better 20 to 30 hours to learn something new, to become better at something. Because it's the long term that matters, right? If you find a way to sell your time only by 10 or 20% more compared to what you're currently selling it for, then that ROI is much, much higher than whatever you could get with any single investment, especially as your wealth isn't yet that large. It's all about figuring out how to grow income quickly. That's what I personally did. I simply looked at what kind of income did I make in a particular month, and I plotted this on a chart, and I simply wanted any given quarter in a year to have more income compared to the prior quarter. So I would change jobs, or would add another side hustle, or I would potentially find ways with investments to make additional money. I always wanted to get more income in the current quarter compared to the previous quarter. And if you do this constantly over the years, then things will play out well. The problem is that most people are already satisfied with the regular raises they get in a company, right? Let's say you get employed by a corporation and you get even a 10% raise after a promotion. Most people are okay with a 10% raise after a year, but that's definitely not quick enough. Especially when you're young, you need to have the target of at least growing your income by 10% every quarter, potentially even faster than that. It's of course harder and harder over time to keep that growth rate, but especially if you don't have that mindset yet and you have been comparatively flat with income over the last years, then this is really what needs to be focused on. It's not about making 100x on your $1,000 investment. It's more about figuring out how to double your income in the next year, double it again the year afterwards, etc. And the way is not easy. It's not straightforward. It means switching jobs. It means switching careers. It means adding more side hustles. It means potentially becoming entrepreneurial, maybe opening a YouTube channel, right? This is what I also did. It's all kinds of approaches. We have to become creative. We have to figure things out, but it's definitely possible, right? There are people that make more money now than you are doing, especially when you compare yourself to your peers. There are probably people that are currently making more money than you, and then simply just ask them, right? How can I potentially transfer whatever you're currently doing to what I'm doing, right? Maybe similar kinds of approaches work for different lines of business. So yes, I do enjoy optimizing my return on investment. It's also the most important thing for me personally, because my wealth relative to my income is comparatively large. But when you're not yet at that stage, then don't focus on investments yet. Focus on income generation, focus on increasing your income long term, having a high savings rate. And then once you're at, say, 1 to 2 years of income saved up. So you've got 2 years of income on the sidelines. That's then the point where we can gradually focus more and more on investments, where then actually 10 or 20% outperformance over just the S&P 500 actually moves the needle somewhat. And of course, that effect compounds over time and becomes more and more important over time. If it's the very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time. Cheers.